It's wild when you actually stop and think about it. You go to work, you put in your hours, you literally create value every single day, right? But you don't actually see a single dime of that money for weeks. Today, we're diving into the story of Advasa, a fascinating Japanese startup that is essentially hacking the traditional payroll cycle and turning it into an on-demand service. Seriously, we live in an era of pure instant gratification. You can stream movies globally in a second, you can summon a car to your door in 3 minutes flat. So why on earth is payroll the only thing that still operates on a rigid, batch processing schedule that feels like it belongs in the 19th century? It's a massive bottleneck that, quite frankly, makes absolutely zero sense in a real-time world. And because of this archaic system, we're seeing this massive gap in the modern workforce. On one side, you've got the gig economy, where drivers and freelancers can often get instant payouts literally the second they finish a shift. But on the other side, traditional corporate jobs are hopelessly stuck with these 2 to 4 week delays. This creates a massive disadvantage for traditional employers trying to attract top talent, especially when everyone is facing such crippling labor shortages. So, to understand how this broken system is finally being fixed, we really have to deconstruct Advasa's playbook. We're going to trace their journey from tackling this archaic payday problem right through to the ingenious tech behind their platform, how they built a massive competitive moat, the market boom driving this, and finally, their ambitious path to going global and going public. Let's start with that archaic payday problem, because to truly understand a unicorn startup, you absolutely have to look at the exact pain point they're solving. The traditional payday isn't just an annoyance. It actively forces people into devastating debt traps. Imagine an unexpected medical bill hits, or your car breaks down, and payday is still 2 weeks away. What do? Well, a lot of workers have no choice but to turn to high-interest payday loans or max out their credit cards. Advasa's core corporate mission was designed around fixing exactly this, contributing to a society where workers can actually work with peace of mind. They're tackling a critical societal need by providing instant funding to diligent workers and completely cutting off that cycle of debt, which is exactly where we meet Advasa and their flagship platform, FukuPay, the technological solution designed from the ground up to break this predatory cycle. The whole concept driving this disruption is something called Earned Wage Access, or EWA. This is the emerging fintech category Advasa operates in, and it's super important to understand what it actually is. EWA is tech that lets employees access their accrued wages in real time, way before payday. And here is the absolutely crucial part. It is not a loan. There are zero interest rates involved. It's literally just giving workers access to the capital they've already generated. Advasa's specific answer to this huge demand is FukuPay. It's a patented, cloud-hosted platform. The true brilliance of this system is that it acts as this invisible bridge, seamlessly connecting an employer's existing HR software directly with global payment networks and banks. The company doesn't have to overhaul its IT infrastructure because everything is hosted securely right in the cloud by Advasa. Okay, so a cloud-based architecture sounds great in theory, but how does the technology actually work for the everyday worker out there on the floor? The user journey is honestly remarkably elegant. Step 1, an employee finishes a shift and clocks out. Step 2, the system instantly reads that time data and calculates their accrued wages right then and there. And Step 3, with just a single tap, an API transfer routes those funds directly to their bank account, mobile wallet, or prepaid card. So instead of your money sitting around idly for weeks, FukuPay streams wages almost like digital data. But here is the absolute genius of their business model, what we can call the Advasa Edge. The platform integrates with these HR systems with zero funding obligation for the employers. Think about that for a second. Companies can offer this incredibly sticky, life-changing benefit to their staff without tying up a single cent of their own corporate working capital. Advasa handles all the liquidity behind the scenes. Now, having an innovative product is a fantastic start, but if you're going to survive in a cutthroat fintech space with massive competitors, you need a serious competitive moat. Advasa's first layer of defense is their deep, strategic partnerships. You simply cannot offer instant money without deeply integrating into existing financial infrastructure. In Japan, they secured some incredibly heavy-hitting partners for real-time APIs, like 7bank, PayPay Bank, and GMO Azornet Bank, plus Sumitomo Mitsui Card for Visa prepaid cards. This infrastructural moat ensures they can deliver funds instantly, 24/7, across multiple mediums. And they didn't just stop at bank partnerships, they aggressively locked down their intellectual property. They built a formidable portfolio of issued patents across major jurisdictions like the US, Japan, and South Korea, with filings pending in over 16 other countries. This isn't just defense either. It creates a powerful monetization channel through software licensing and acts as a massive deterrent against anyone trying to copy their underlying architecture. So, why is this specific technological plumbing causing such an incredible market boom right now? Well, the market for earned wage access is experiencing an unprecedented exponential explosion. Analysts are projecting absolutely staggering valuation expansions over the next decade, and it's driven entirely by an unstoppable global demand for flexible payroll. The workforce has fundamentally changed, right? Millennials and Gen Z are taking over, and they expect the exact same real-time functionality from their employers that they get from every other app on their phone. On top of that, beyond just corporate workers, there's a staggering global population. We're talking literal billions of people who remain completely unbanked. This technology is a massive driver for worldwide financial inclusion. By offering funds directly through mobile wallets or prepaid cards, platforms like Advasa can completely bypass traditional banking hurdles, bringing real financial agency to underserved populations in emerging markets. With the tech proven, a deep moat constructed, and market demand skyrocketing, it was time for Advasa to focus on going global and ultimately going public. Their timeline captures a breathtaking ascent. They were founded in Tokyo back in 2017, hit a critical inflection point with major bank integrations by 2019, and by 2024, they were officially recognized as a unicorn startup. Now they are preparing for the ultimate milestone for any tech company, an IPO filing for the Nasdaq Global Market. It is a classic, awe-inspiring startup story. And that operational momentum has translated into explosive business growth. By strategically transitioning into a highly scalable, high-volume fintech transaction model, they've proven that the unit economics of real-time payroll actually work brilliantly at scale. They're seeing massive year-over-year revenue leaps by successfully capturing the value of the vast transaction volume flowing through their network every single day. To sustain this hypergrowth, they are aggressively scaling beyond Japan. But as any founder knows, you can't just copy and paste fintech across borders. Advasa is meticulously adapting localized compliance strategies for launches in highly complex markets like Indonesia and the UAE. Navigating those distinct local labor laws and financial regulations is tough, but it forms yet another massive barrier to entry against their competitors. Which leaves us with a truly provocative question. As earned wage access rapidly becomes the global standard, will the traditional 2-week payday eventually become completely extinct? Honestly, how much longer will any of us accept waiting weeks for the money we've already earned? It's a fascinating shift in power between employer and employee, and ambitious companies like Advasa are the ones actively writing the code to make it happen. Let's look right under the hood of Advasa Holdings as it steps onto the Nasdaq Global Market under the ticker ADBT. Their financial architecture is, honestly, anything but traditional. We're looking at a Japanese fintech, but they're operating through a remarkably lean Delaware holding company, and their ultimate goal? Exporting a patented digital payroll platform across the globe. To really decode this public market debut, we have to look past the surface-level narratives and zero in on a massive structural transition happening right inside their financials. The entire trajectory of this market debut really hinged on one specific date, March 12, 2026. That's when a $15.96 million private placement from Akira Iwasato hit the books. And it didn't just inject some capital, it completely flipped the balance sheet. By late 2025, they was suddenly sitting on $17.24 million in positive working capital. And out in the public markets, balance sheet strength dictates your entire strategy. Because of that crucial capital injection, Advasa was able to walk right away from what would have been a highly dilutive small-cap IPO. Instead, they completely restructured the deal. They pivoted straight to a direct listing on the Nasdaq, registering the resale of just over 94 million shares held by existing stockholders. The mechanics of this specific path are absolutely critical if you're building liquidity models. You see, there's no underwriter book building here to artificially stabilize the stock, and the company itself receives zero proceeds. So pricing out of the gate, that's going to rely entirely on the willingness of these current registered shareholders to sell into organic market demand. It is a pure, unfiltered test of price discovery. Without that institutional safety net, retail and institutional players are stepping into an arena where order flow is literally the absolute arbiter of value. So if pure market demand is going to dictate the price, we need to talk about monetization and their bank ecosystem. We have to tear down the operational engine that actually builds that underlying valuation. To accurately price this stock, you really need to understand the architecture of their flagship platform, FukoPay, and exactly how it pulls cash out of the ecosystem. At its core, the platform operates in what we call the Earned Wage Access Space, or EWA, but it's their proprietary mechanism that really matters here. FukoPay integrates directly into an employer's HR software to calculate and disperse accrued employee wages in real time. Now, the absolute crucial differentiator, it completely transfers the wage advance risk and the funding obligations right off the employer's balance sheet, pushing all of it onto integrated financial partners. And that brings us to their API ecosystem, which is Advasa's true competitive moat. They aren't just some thin software layer, they're hardwired directly into national banking infrastructure. We're talking direct integrations with 7bank for real-time ATM payouts, Sumitomo Mitsui for Visa prepaid direct charges, and PayPay Bank for digital clearing. That kind of interconnected web creates instantaneous execution and, frankly, a remarkably high barrier to entry for generic HR software competitors trying to edge into this space. While the model is definitely proven in Japan, the real growth thesis relies on exporting this architecture. Right now, Advasa is aggressively targeting market launches in Indonesia and the United Arab Emirates. But keep in mind, this isn't a simple software copy-paste job. It's an incredibly complex pipeline to adapt their deeply bank-integrating model to fit the rigid, highly localized financial compliance laws in those specific jurisdictions. And that aggressive operational expansion, well, it's leaving a massive footprint on the financials. When we pull apart the income statement, we uncover a highly volatile and frankly critical revenue shift and margin transition occurring right in their underlying business model. It's exactly the kind of structural shift that changes how a company is fundamentally valued. On the top line, the growth looks spectacular. Revenue surged 72.9% year over year, climbing from $10.4 million in fiscal 25 up to $17.36 million by March 2026. But we have to look closer here. This isn't just linear growth. It's a fundamental pivot away from lumpy enterprise software licenses straight into high-volume transactional EOW fees. But as we know, volume comes at a cost, and investors really have to digest the resulting margin compression. While top-line revenue climbed, gross margins took a severe haircut, falling from 22.8% in FY25 down to a razor-thin 12.6% in FY26. Basically, the high-margin days of pure software licensing are being heavily diluted by the massive clearing costs of pushing millions of real-time micropayments through those banking APIs. To understand why this margin shift happened so violently, we have to look at a very specific catalyst in FY25, a 57.3% plunge in their software licensing revenue. What happened was a renegotiated contract with a major enterprise customer drastically lowered subscription rates. That event effectively forced management to accelerate their reliance on the transaction-heavy side of the business just to keep the top line growing. Now, fortunately for their cash runway, that sudden drop was bridged by an anomaly. They managed to secure a massive one-time system update order that spikes software maintenance revenue by 232.5%, bringing in an offset of $6.36 million. But as investors, we need to realize something. That one-time cash injection effectively masked the structural margin transition taking place underneath. The core business is just entirely different now. The big question now is whether that new transactional volume can actually sustain long-term profitable growth. To answer that, we have to look beyond Advasa's immediate balance sheet and measure the macro labor market tailwinds that are driving digital payroll adoption globally. Because if the margins are getting thinner, the absolute volume has to be there to justify the market valuation. And the industry projections here are pretty staggering. Analysts estimate the total addressable market for EWS software will hit $26.74 billion by 2030. The traditional 2-week pay cycle is rapidly becoming an obsolete friction point, and demand is absolutely surging for agile payroll systems that actually match the speed of modern, real-time consumption. We're actually seeing this play out in real time in Advasa's home market. Japan is currently grappling with severe structural labor shortages, particularly in sectors like retail and logistics. The power dynamic has shifted decisively to the employee. So for Japanese corporations, plugging into FukoPay is no longer just a nice-to-have HR perk, it is a strategic necessity for recruiting top talent and slashing those incredibly high turnover costs. Beyond just tight labor markets, there's a secondary, vastly larger macro catalyst to consider: the 1.7 billion unbanked individuals globally. As Advasa pushes into emerging markets like Indonesia, their digital wallet integrations act as a vital on-ramp for individuals who operate entirely outside the traditional banking system. That is a massive demographic for inclusive financial capture and a pure volume play for Advasa's transaction engine. But look, no financial analysis is complete without a rigorous stress test of the bear case. Let's talk about the key investment risks. As this stock hits the public markets, there are very real structural vulnerabilities that both retail and institutional investors need to price into their models. The upside is definitely clear, but the floor is entirely dictated by the risks. The risks here are deeply multi-layered. Beyond the margin compression we just discussed, look at the corporate structure itself. Advasa Holdings, the actual entity listing on the Nasdaq, is a remarkably lean Delaware shell company. In fact, if you check their recent SEC filings, it reveals they have exactly 2 full-time employees. It is 100% dependent on the cash flow, the IP, and the management of its operating subsidiary all the way back in Japan. And that geographic disconnect introduces some intense foreign exchange exposure. The vast majority of Advasa's cash is generated in yen, but they have to report earnings to U.S. investors in dollars. When the Japanese subsidiary upstreams dividends, fluctuating currency rates can trigger massive exchange gains or devastating accounting losses that are entirely outside of management's operational control. Add to that a labyrinth of cross-border regulatory complexity. They are answering to the Financial Services Agency and Ministry of Finance in Japan, alongside the SEC and IRS in the US. Because earned wage access sits in this sort of regulatory gray area between payroll software and digital lending, there is a constant looming threat of retroactive non-compliance judgments as financial laws evolve around the globe. Now, management is acutely aware of these pressures. Their primary defense mechanism against that margin compression is a strategy to aggressively monetize their intellectual property. Armed with 9 issued international patents, Advasa is pivoting toward high-margin OEM licensing partnerships. Basically, if they can license the back-end tech to regional banks and HR providers without eating the direct clearing costs themselves, they can push those gross margins back up to a healthy level. So, as Advasa tests the waters of the Nasdaq through this direct listing, the entire investment thesis really boils down to one critical question. Can a highly localized, bank-integrated digital payroll model successfully scale into a global standard, or will the crushing weight of international regulations and razor-thin transaction margins throttle their first-mover advantage? It's a fascinating structural test of modern fintech, and the public market is about to decide exactly what it's worth.